Welcome, everyone. We are going to get started on our little webinar event. Basically, this is the information. We're going to do a 30-minute presentation on the recent tax legislation that was just signed by President Trump. We're calling it the Trump Tax Bill 2025. There is a significant amount of content that this legislation has. So what we have done here in the interest of time and efficiency and trying to break this elephant down to a couple of bite-sized pieces is we have taken the material and formatted it over five separate sessions that are each 30 minutes. I don't think anybody wants to spend more than 30 minutes learning about tax law without getting a headache. But we're going to make it interesting and a little bit of fun. But it's going to take us a little bit of time to go through all of the things because it is just so sweepingly big. So I'll give everybody the schedule. It's going to be the same time and the same day for the next 5 weeks. And you'll get the same cycle of invite, and that'll come to you in an email. And then I'll go through some of the other additional information that you're going to get as a result of attending. There's just a lot of material to cover because there's so much that affects so many people. But we'll do it, and we'll do it in a very, very efficient way. And I think everybody's going to learn an awful lot about just a lot of stuff that we're going to be able to do. So with that said, let's go ahead and dive in and get started. The dates, and we'll send out an email to everybody for the next, for all five sessions, starting tonight, July 17th through August 14th, same time. And everybody will get an invite. Everybody will get notice, and we'll keep everybody up to date. And with all the material, there'll be a lot of information that you'll be able to download and have access to that will be supplement to the content that we're covering in each of the sessions. What I'd like to do is also let you know that we have an extensive guide that has been created and is being finalized. It is scheduled to be published and released November 1st, but we're going to make it available in an early release for you over the next, I'm going to say 6 to 7 weeks. It's in final editing right now, and then I've got to send it over for art and design to finish, and John will be helping me with that. But I would say sometime in the next 6 to 8 weeks at the most, we'll have an early release version that you'll be able to get, and it will be absolutely free. You'll want to hit that link, and you'll get an email on this with this link. You're just going to hit that link and put your email in to get on that early reserve list so that you will reserve a free copy for yourself. It's an extensive guide, and it has more than just the stuff about the legislative changes. It actually has working examples. It's going to have some worksheets. It's going to have different applications and different parts of the laws that have changed and how they're going to impact people. And it goes into some detail on some of this stuff that could be a little bit confusing. We've made it very easy to understand with some of the illustrations and some of the case examples. So this will be a very important guide. We're going to be putting it up on Amazon November 1st when we publish and release it. And I think we're going to sell it for probably about $34.95. It's a couple of hundred pages. So it's a very, very extensive book. And it's going to have a lot of shelf life because it's going to be something that you're going to want to refer to, especially if you've got somebody doing your taxes that hasn't kept up with these changes, because they're going to get very confused with some of this stuff pretty quick. Tonight, we'll start with the 30-minute first session. You'll note each session and the recording that we're doing. You'll also have access to the recording so you can go back and listen to it. Tonight, we're just going to call this session, not only session one, but profiting through structure. A good part of the tax legislation and these changes deal with how things have been structured and how they're being restructured. Trust and estate, corporations, LLCs. We've been used to a pretty predictable model defined in the tax code for the last 2 to 3 decades. That's all changed in terms of how structures are looked at, particularly with estate planning and particularly with corporations and business entity structures. So profiting through structure really means to understand whatever structure you have for your business, whatever structure you have for your retirement, whatever structure you have for your investments, whatever structure you have for your trust and estate, everything has been affected. And so what we want to do is make sure that you understand each of those transient applications of impact, identify them so that you can understand how it's affecting or how may be affecting you. Important to note that we have highlighted 30 sections that deal with probably, I would say, 90% of the country. Taxpayers that have jobs, taxpayers that are retired, taxpayers that are business owners, business entity structures, trust and estate structures, audit, compliance enforcement. A lot of these changes that have been enacted, we haven't seen this big of a change since the Tax Reform Act of 1986, when that was probably the biggest change that we'd seen since the 1960s. And the challenge right now is how do you take all of this and digest it and make sense of it so that you can look at something and look at your situation to see where it's applied or how it's being applied and how it's affecting you. And I think that's why this guide that we've created is going to be so useful and important, because it's going to give you a step-by-step process to do that. This is like the first 10 items or sections that we've divided the legislation into. These are structural changes. These have to do with some of the laws being made permanent, some of them having sunset provisions, some of them being eliminated. The next 10 deal with preference items, basis adjustments on death of a taxpayer for estate. There's been some significant changes on how that works. And the last 10 deal with more of the coordination between the code and the regulations and how it applies to your personal, to your business, to your trust, to your corporation, or to your estate. So there's a lot of meat on the bone here to go through, and we're trying to take the approach, or we are taking the approach, at least in the guide, where you can go through the guide as we have with each of these recorded sessions. So you could actually sit there with the guide and watch the recording and actually integrate both of those together, where it's going to make a lot of sense for you to be able to understand how these changes are going to affect you, because they will affect you. With that, the main purpose is to introduce the core structural changes that the legislation brought when the president signed it on July 4th. And the best way that I could explain this is that if you take the legal structure of a corporation, whether it's a C Corp or an S Corp, or whether it's an LLC as a partnership or disregarded entity, you take the legal structure and you decide based on what the law was before it was enacted and then what the law was after it was enacted, that's a pretty easy analysis to parlay and to define. The challenge is all of the laws have been made retroactively applied or applicable back to January 20th of 2025. So not only do we have the complexity of the structural change of the law as applied, but now we've got to go back in time to January 20th, the day the president was sworn in, and all these changes are retroactively in effect as of that day. So if you bought a piece of business equipment on March 1st and they signed the law July 4th, you're going to get all the benefit retroactively for when you bought the equipment because it was after January 20th and before the law was signed on July 4th. Calculating that benefit, here's where the challenge is going to be. A lot of people are going to miss a lot of the benefit because they're not going to understand or know this retroactive application and how that is computed, because it's going to have a big impact, particularly on basis adjustments for real estate and equipment and leasing, and it's pretty far reaching. So we've tried to take that one issue and thread that through everything that we've created so that you're reminded you've got to go back in time and you've got to look and do the analysis, because if you don't, you're definitely going to lose a huge amount of tax benefit, and it's going to cost you rather than pay you to pay attention to that. We're going to start with 4 sections tonight. The first one is the entity level impacts. This is formal structures like S corporations, C corporations, and LLCs. And they have significant changes that have been made as a result of the legislation, and they're all retroactive back to January 20th of this year. One of the big key elements with this particular piece of legislation is every part of it is a new planning opportunity for you. There is literally nothing in this legislation that is escaping the opportunity for you to do additional planning, and that additional planning will save you significant amounts of tax, both now and in the years ahead. What's important to understand is your ability to measure the future impact in the planning by understanding how the change is applied to your situation. And that's actually pretty easy once you understand if you have a business corporation and you have an S election, you're probably going to be among a number of people that are going to revoke that S election because it's now more favorable to look at a C corporation because of some of the permanency provisions that were enacted in this new law. And I haven't seen that in probably 30 years doing this, and where a C corporation actually is going to make really good sense now. So we're going to cover 3 areas: C corporations, LLCs, and S corps. The highlight right now, the big impact, and this is significant, is permanent legislative enactment. C corporations are capped at 21% flat tax, now permanent. Well, what this does is it makes it an ideal environment for a C corporation to actually hold appreciating assets when cash might not be needed in the short term, like through distributions or profit distributions, like you would get from a partnership or an S corp. You could actually look at a C corporation holding real estate now in a way that would cut your tax bill by more than half, or any other appreciating asset. I can think of one right now, Bitcoin. I'm going to see a lot of clients in the next few months that are going to be moving their digital asset Bitcoin holdings into C corporations because their taxes are going to be radically much lower now and in the future. This also has some significant impact on estate planning and basis step up, and I'll get into that in a little bit. So every estate attorney, every living trust, every estate document that deals with holding real estate is going to have to be reviewed because it has a significant impact on the basis adjustments. For LLCs, the QBI, qualified business income deduction, is now made permanent, 20% for an LLC and for any other business entity. The flexibility over that single layer taxation remains unmatched against any other model. Even if you used an MCC pairing recommendation, which is a management corporation conduit structure, you could literally end up cutting your tax liability by 80% now. And this is such a big impact that it's going to have in driving more revenue into the hands of the business owner by keeping more of their money because they're not going to be paying these taxes that we have been accustomed to, and it's going to be a very different environment. Similarly, with an S corp, the QBI was also extended, but the IRS enforcement now, and I think they got an extra $1 billion budget, and I'll get into the enforcement provisions on S corps. There is a direct and an expanded initiative program for S corporation compliance enforcement. We've heard talk of this for several months. I've actually read some of the legislative enactment stuff that were going into the bill and the policy guidelines from the IRS. So I'm already well ahead, and I already know how they're going to be doing the enforcement and the examinations and the audits. We'll cover that. But what I will say is that if you've got an S corporation, you should absolutely go through a compliance audit review and go down a checklist, because if anything on that checklist is missing and you get audited, you're going to have a disregarded entity and they're going to drive a truck through your S corp. The key change on the C corp, not only the 21% flat corporate tax rate that was first enacted in 2017, it's permanent, but also ensures long-term planning and certainty because it's going to support reinvestment of profits inside of the corporation, and you're not going to have that dilemma of excess profits tax because you haven't distributed the profits or reinvested the profits. So that's a big deal for corporations that have that dilemma with retained earnings or with not distributing enough of their profits. You're not going to have that problem. And more predictably, if you have any asset that's appreciating, like real estate, you're going to be a much more favored position to have a reorganization structure of a C corp so that you can take advantage of that retroactive back to January of this year. That means a lot of people that have paid estimated taxes are going to have a refund or can get that money back, like right now, on a refund. And that's a big deal for a lot of people, and that's the part of the purpose and the design. Strategic, in terms of how to be strategic with this, I just picked a few examples. There's about 36, actually. I just picked a few examples just to give you a flavor. C corporations are going to be much more appealing now as a holding company. And anything with a high value long-term asset like ADUs, multifamily, we have a 5-unit or a 10-unit, commercial property, anything with a useful life depreciated asset where you can take that surplus cash that you would otherwise be distributing and paying taxes on you can now reinvest it and have a much more favored tax position. And long term, especially for estate tax planning purposes, you're not going to have those customary tax traps with basis step up or depreciation recapture on the passing of one of the shareholders. You're going to have a much more tax favored position. So this is going to be probably a full employment act for attorneys and accountants for the next 5 years, reorganizing business entity structures to holding companies under a C corporation and getting rid of S corporations. Also, the tax rate at 21% locked in would encourage the incentivization of retained earnings and long-term growth because you want to reinvest that. And here's the thing that's really important. For large estate tax exemption, the $15 million per person reduces the death tax on the appreciated corporate share. You're not going to have death tax on that. When those stocks are reevaluated at a higher rate, they're not going to be subject to the death tax. That's significant. So you can see a lot of opportunity for new planning that's going to be taking place because it's going to change everything in how you look at the value of your business and succession planning and estate planning. There's still some subject to double taxation. If you take the dividends, you don't get a deduction at the corporation for the dividend, and then you get paid the dividend personally. You have to pay tax on that at your normal bracket rate. So you don't get out of that, but what you do get is you get an expansion of some other planning features that I'll cover in a minute that give you an opportunity to mitigate that. And up to about $10 million, in other words, if you have a corporation that's making less than 10 million or has less than 10 million, you're going to be in a much more favored tax-centric position than you've ever been by just considering a reorganization structure for your entity. Looking at using C Corp entities for holding companies for appreciating assets is one aspect, but we'd also look at those strategically as a conduit holding company to hold shares of an LLC where the LLC owned the apartment building. And by doing this, we get tax favored position for the corporation. We're still bound by the partnership rules for the LLC, but now we've significantly reduced our tax exposure for the management conduit, and that probably on average would save the average investor, anywhere from 50 to 70% of their taxes that they would otherwise be paying. So that's going to be a big planning opportunity. The permanency of the 21% corporate tax rate is absolutely a shift because the long-term asset holders of real estate investors, whether it's commercial, residential, multifamily, it's going to change how those investments are structured. And it's going to change it based on the driver of the 21% tax rate. And unlike temporary, when the law was temporary, that was passed in 2017, it's now permanent going forward. And so for the predictable, I would say next 10 years at least, as we see this real estate market going through radical changes, this is going to absolutely give an incentive for those changes because they're not going to have the severe tax consequence that they once did. For investors that have portfolios, whether they're ADUs, rentals, real estate development, the C Corporation is also going to allow a lot of that capital to stay in the CapEx direction of the investment purpose for the entity and let that appreciate with no tax consequence and no additional tax that you're going to have once you pass through the profits like on an S Corp or an LLC. So what this does is it gives some additional opportunity for planning if a business or a developer wanted to do self-financing for expanding, let's say a vertical integration of a development project, they're going to be in a much better position financially to use this new structure to do that and get a lot more in terms of the tax benefits. Whether you're a small business or a large business, the C corporation is going to give you a lot more benefit than it's ever given before. So short-term planning, I would look at, evaluate any real estate holdings that you have, any business interests that you have, any appreciating assets, and how much we can bundle in a reorganization structure to a C corporation, and look at debt and how that debt can be better managed through the corporate structure, or even new acquisitions. You might want to consider that next property to be under a C corporation umbrella to get that benefit that you would otherwise not have been able to take now that the law has been changed. Then for planning on long term, it is going to have an impact on family trust and holdings. So if you have a trust attorney, you're going to want to at least make sure that your trust and your assets are congruent with the changes in the law. We do a tax pro forma before a client meets with their attorney, so we can run all of that data and those numbers. But you want to look at share transfers, and you might want to look at reorganizational structuring of a C Corp to give you some succession planning opportunities that probably weren't there before. In any case, you're going to want to meet with your tax professional and your estate planning professional and look at the opportunities that this law and these changes are going to bring to take advantage both now and in the years ahead, especially because you're not going to be in a situation on a death where you have to recapture the depreciation and step up the basis as part of that. Monitoring and maintenance, tracking retained earnings obviously is going to be the biggest thing. Corporate formalities, this is all part of the compliance enforcement because they're going after all corporations, especially the closely held small corporations. And this whole area about formality, minutes, bylaws, officers, elections of officers, all of those things that preserve the legal protections of the entity integrity are all now part of that audit enforcement. And I'll talk about that when we get to that section. Limited liability companies, the biggest thing here is the QBI deduction, 199A, 20% write-off on all qualified pass-through income, now permanent. And it's been extended for LLCs, partnerships, and sole proprietorships. This extension secures a major tax advantage for businesses operating through pass-through structures and is a perfect environment for management conduit corporations and income shifting. You're talking about a 50% reduction in your taxes for a business just because of this particular structure. Some of the cons, if you will, the negative side, is that the QBI is not eligible if the taxpayer hasn't materially participated. In other words, if it's a passive activity, then you don't get that QBI 20% reduction. The other part on the action step is to the extent that you do get the 20% and it's a pass-through entity like an S Corp, you have to really make sure that salary, accountable reimbursements, all of those things are lined up and those agreements are renewed every year, because if that's not done, then the whole thing falls apart. And then lastly, for after cash, where it used to be an after tax consideration, this is going to bring a lot of simplicity to the accounting and bookkeeping. You're not going to have all of the complications that were previously part of the nightmare of how to figure out different issues from the accounting standpoint. And secondarily, if you're using a management conduit corporate structure with an LLC, which has become more popular, I've been using those as part of planning for probably 20 years. The conduit part of that structure is really where you want to shift the pass through, the QBI, and all of the salary and benefits, because that's where you're going to get the most bang for the buck in terms of the net tax savings. Let me go back. There we go. One other planning is that, and this comes out of the compliance and enforcement initiatives, for officers or members of the corporation or the LLC or partnership, members and officers' hours have to be tracked for any services performed. And not only do you have the reasonable compensation requirement, you have to track the hours of participation because it's a material participation hours test. If you don't have an hours record test that you can meet, it will be deemed a passive activity, and then none of these benefits are going to apply. And that's an area that is going to be expanding, is already expanding in compliance and enforcement and exams, audits. S corporations obviously reduce self-employment tax on the pass-through, and it allows the owner to shift or split income between salary and pass-through profits, profit distributions. Whether you take them or not doesn't matter because it's an imputed profit distribution based on the books. The challenge that you're going to have now is the IRS initiative for compliance and enforcement on reasonable compensation, and that includes benefits, accountable reimbursement. It includes a wide list of things. And no longer are we looking at the typical audit notice. They're actually being much more aggressive in looking at a whole host of other information and cross-referencing and matching that, and then issuing proposed assessment notices, but without even an audit. And so if you're the unfortunate recipient of one of these in the next 3 or 4 years, you should have an action plan of how you're going to respond. We're going to have a checklist in the guide. I would just follow that checklist, because if you don't have everything on that checklist, you're going to have a problem passing any kind of scrutiny in terms of a proposed adjustment. And it's a big deal because they're putting over $1 billion in the budget for this enforcement initiative with the idea that they're going to be able to get 5 to 1, $5 billion in additional revenue for the $1 billion that it's going to cost them. I don't know how they got that number, but that's the number they're using. S corporations that exist for certain kinds of businesses now might be disfavored. Manufacturing, product, auto body shop, construction, probably not a good entity structure for those kinds of businesses. S corporations are now going to be more favored toward service-related consulting, service commission-based income, because when you pair the S corp with an LLC to hold the appreciating asset of the business, like a rental property or a business office, you're going to get a much better blend of tax liability than you would otherwise have with just the LLC. But basically, S corporations have lost a lot of their favor in usefulness for a lot of different types of businesses because of this equipment and appreciating and depreciating asset structure has radically changed. It doesn't make good sense now when a C corporation can do so much more. Also, corporate records, minutes, payroll logs, officer resolutions, all of those things are now going to be part of the analysis and the deep dive that the IRS is going to be doing when they start auditing these. One little commentary is IRS is fully aware that many S corporation owners underpay themselves. They don't take enough reasonable compensation. And they do that to maximize pass-through income, avoiding the self-employment tax. Well, this has become a major enforcement focus under this new law. And this was one of the battles between the House and the Senate, was how much was going to go into this enforcement. And this is what delayed it to one extent, was one of the reasons. The IRS is now armed with much greater funding and much clearer authority to investigate and penalize S corporations that fail to issue reasonable compensation to their shareholders. And they don't even have to audit. They can just look at a couple of pieces of data that don't reconcile or match based on the matching information, and they'll just send a notice of proposed adjustment, and then you've got to fight with that as if an audit had already happened. We've done a lot of work, an extensive amount of work in putting together the proper defense structure for those kinds of situations. So we're going to include that in the guide. So when you get a copy of that guide, you're going to have a section that's going to go through in depth of how to navigate if you get in that situation. Planning opportunities. If you have an S corp, you should probably do some planning before October 1st. You're probably going to be the one of the 9 out of 10 that are going to want to consider reorganizing and revoking your S election, and you want to do that before a certain date. So by October, you would want to have that decision made, because you have a statutory time before the end of the year in which to revoke the election for the next tax year, and you don't want to miss that date. And I would certainly encourage a review if you have an S corporation, because it could save you literally tens of thousands of dollars both now and in the years ahead, and avoid a lot of other problems that S corps are going to have now. Long-term planning. Again, for any amount paid to a shareholder, the rules are going to be much more rigorous. There's a whole section in the guide. I would just say make sure you've got really good record keeping. And if you don't, fix the record keeping, because remember, they can go back 3 years, and they will, on any proposed assessment. Monitoring and maintenance, make sure that the QBI deduction, the analysis, you actually have to do the worksheet for that deduction. And if you don't have the worksheet and you get audited, you're going to have a problem, because that's actually part of the record keeping. We do that as part of our software when we do it for a client, but most clients aren't aware that they're supposed to do that worksheet. It's not supposed to be filed with the return, but if you get audited, you're supposed to provide that. And that's one of those things that, people think, well, it's not a big deal. Well, it's kind of a big deal, because there's some adjustments on there that most people don't know or don't understand that would otherwise prevent them from getting that QBI deduction. Strategic shifts. These are changes in the law where something that was strategic, like equipment, depreciation, basis, shifted. It's still available, but because of the enactment of the law, it's now shifted, and its composition or its usefulness has transformed or changed radically. So we're going to cover in this session a very narrow section that deals with some of these strategic shifts. There have been strategic shifts that we'll cover in each of the 5 sessions, but this is the first one that we'll cover in tonight's session. Again, measuring future impacts in the planning are all about planning opportunities. You're going to have plenty of opportunities for that. The key shift that we want to look at right now is bonus depreciation phase out will continue. You'll get 40% in 25, 20% in 2026, and 0 in 2027. So for front-loading depreciation through cost segregation on rental property and equipment, blah, 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 that benefit for the bonus depreciation is going to go away by 2027. because you're no longer going to be able to front load and get the bonus depreciation. You're going to get some other things that are probably better anyway, but you're not going to get this. So the phase out is going to significantly reduce the ability to shelter through accelerating or front loading the depreciation, on furniture, HVAC, appliances, cabinets, those kinds of things on rental property. There was a huge advantage to front loading that through cost segregation and then doubling up and getting that bonus depreciation. And it gave people a lot of incentive financially because you could front load the depreciation and in the first 5 years pay for probably 50 to 60% of the cost of the property with the tax savings. That's all going to phase out and go away. But because of some other enactments, you're going to have a much better situation long term anyway. Anything with real estate, you're going to need to plan. The depreciation phase out with the bonus rate dropping to 40% this year and 20% next year is really a matter of timing. If you've already bought equipment, it's retroactive back to January 20th, but you want to do this other analysis to understand that there's another way to look at that, and you may not want to take that look back and be aggressive. You may want to be a little bit more conservative and using that going forward. So it's really important if you've bought equipment this year or you're going to invest more than $10,000 in equipment or fixtures, you're going to want to do that look back analysis because there really are two distinct differences. One is going to be more favored long term than the one that is going to be less favored short term. So I would just suggest that you do the analysis and follow the numbers because it'll be clear what's going to give you the better advantage. For short-term planning, make sure all your capital improvements and acquisitions are done and completed and placed in service by December 31st of this year. They actually have to be placed in service. If they're not placed in service, you don't get it. You don't get any of it. And that's a big audit enforcement issue now. They're going to look at the $25,000 of appliances that you bought for your apartment, your ADU, and they're going to look to what you can substantiate in the 5 points that shows you actually placed the ADU in service before December 31st of the year. If any one of those 5 aren't checked off, you don't get any of the deduction. It follows into the next year. So you could have some problems just with the placed in service issue. Long-term planning, any equipment that you're planning, any improvements that you're planning, any acquisitions that you're planning, or dispositions, you're going to sell a piece of property, and you've got recapture issues to look at. I would suggest seriously that before you complete those transactions by the end of next year, do a pro forma review. If your tax professional doesn't do pro forma reviews or doesn't have the software to do that, let us know. We can generally give you a complimentary preliminary one at no cost. Happy to do that to give you some idea. But without that pro forma review, you're not going to be able to make that decision because it's kind of complicated and it's not something you want to try to do by hand. The software actually takes all of these factors into consideration, but there could be a tax trap in this section if you're not paying attention to how this stuff is placed in service and when you're going to acquire it or when you're going to dispose of it. Also, your cost basis and your recovery periods and how you're taking the accelerated bonus depreciation can have a big impact on the subsequent later recapture issue. So that's why that pro forma analysis is another reason why you want to do that. These are the areas where the audit risk has now significantly increased. particularly for S corporations and closely held LLCs. Again, compliance opportunities are planning opportunities. They're opportunities for you to review and do some planning and get into a much better position. The key changes are the strategic impacts affecting S Corps primarily. S Corp owners who take distributions in excess of or in lieu of a reasonable W-2 salary are going to be a primary target for IRS enforcement, probably for the next 3 to 5 years. So any business owner who may have avoided payroll taxes by characterizing their income as a profit distribution without any salary or really low salary is at serious risk of a disregarded entity status and reclassification and back taxes and the highest level of penalties, which I think are 40%. Additionally, not only the S Corps, but partnerships and LLCs with incomplete member rosters or undocumented profit sharing arrangements or irregularity K-1 allocations, and I see this a lot on K-1s, are now at a much higher risk of audit and scrutiny by the IRS. Even those proposed notice of changes that don't even have an audit, you just get a change notice. And then you're told to pay this tax. You got 30 days to dispute it and protest it. Otherwise, it becomes permanent, and then they go after you for the money. The audit risk has shifted away from the larger down to the smaller business because there's a lot more alleged abuse at that area. So when you're looking at things like formal documentation for a per diem for mileage, accountable reimbursement expenses without the proper documentation or agreements, which you have to do every year, the at-risk rules, the rules of the timing, you have so many days once you have the expense to turn it in, and so many days to pay it. And if it isn't within those days, it's not allowed. So you have a whole plethora now of compliance stuff, including meeting minutes and board resolutions approving of the accountable reimbursement, officer logs of time, verifying the corporate activity that was related to the reimbursement plan, and that it meets the IRS substantiation rules and return of excess standard rules. So all of these things that probably don't exist for a lot of people are now going to be the subject of this area of IRS enforcement. Compliance enforcement is what they're calling it. Also, making sure that all active S Corp shareholders who provide any service, they have to document their hours, supported by job descriptions, time logs, market benchmarks, and a comparative salary analysis. Well, we have the credentials to do that valuation analysis for salary, reasonable salary. We bought the software, it's about 20 grand. We can do the salary analysis, and I can tell you if you get $1 million gross income, $250,000 profit on your S Corp, and you have a $50,000 salary, you're probably going to get tagged. And if they say, well, the salary is okay, but let me see your salary compensation analysis. And if you don't have that, then you're going to lose because they're going to assert that the salary was unreasonably low and was not substantiated with the salary analysis finding or report. It's just one of the things that they're doing now. Make sure that if you have accountable reimbursement plans, that they're enforced properly and that they meet all of the requirements of corporate operating agreements, bylaws. All of those things have to line up. Make sure that you're holding the formal meetings and you're having minutes of the meetings and all of that stuff is taken. S Corps are going to be a big target now. and all of this is going to be up on the block. Short term, I would look at just simply reviewing status, where you're at, what you have, and just go down a checklist of things. And anything that you can't check off is something you probably need to fix. That's step one. And in terms of fixing it, I would say that the best thing to do is to make sure that the three different buckets that a shareholder gets, salary and compensation, profits and distributions, and reimbursements and benefits, that they are all clearly delineated on the pay stub. Because if they're not, they're probably going to be disallowed. Audit risk, we're going to see a lot more S corporation audits, as well as compliance adjustments. They got, again, I think they got an extra $1 billion for budget just for that. We're advising everybody that has these kinds of entity structures, at a minimum, you should be doing quarterly reviews across all of these areas and making sure that you have a compliance review consistent with all of these new requirements and these guidelines. Again, the book and the guide will have a checklist that you can take a look at. All right, now there's 6 moves to make as part of this legislation. I'll cover these shortly because this will segue into next week and be sort of the intro to next week. I'm trying to keep this where it doesn't feel like a class, but it's kind of dry stuff. It's important to say that we've just started. We got 4 more weeks of a lot more stuff here. And a lot of it is good. Most all of it is good, but there are some really, really serious tax traps that, are now something that you've got to pay attention to, because the changes that they have been enacted and the revenue that they're going to generate from noncompliance is like a lot. And so they're not going to be kidding around about this. These 6 changes deal with anything from restructuring the entity for a reorganization for the QBI to take advantage of that, to running cost segregation for assets that are placed in service by 12/31/25. For structural review, C Corps versus LLCs, estate freezing strategies, or documents that we would use to pay officer salaries and S Corps. All of these things fall under 2 different groups that are either structural or strategic in nature, but they go to the ability to have significant tax savings if you use these correctly. The first one is restructuring the entity for permanent QBI deduction. That's a basic reorganization plan. We get rid of the S Corp. We now are a C Corp. We do a reorganization plan. We take advantage of the 20% qualified business income deduction under 199A. And we make sure all these things are checked off. And we're converting maybe the S Corp to a partnership with a management C Corp as a conduit. That alone probably cuts 90% of your taxes and gives you the opportunity to take advantage of reorganization planning and accelerating some of your income, because you're going to be in a much lower bracket by the end of the year. You would want to be able to accelerate more of that income because you're not going to have the tax hit that you thought you might have. So this is a really great opportunity to be looking at those kinds of planning options that you're going to have available. The next one is running cost segregation and placing assets. It is really important that when you take a depreciation or a cost segregation approach on an asset that's a depreciable asset, it's really important that you can document that you placed it in service as an income producing property or as part of that business equipment on a specific date. And you go down the checklist, and those things have to be in the file. You have to have those records to demonstrate that it was acquired with that purpose and intent, and it was actually placed in service on that date. Anything on that list that's not checked off makes it null and void and not placed in service for tax purposes. I would suggest conducting an IRS audit review. Look at the compensation, look at your compliance structure, look at your reporting, and look at your record keeping. Then look at your tax return, look at the balance sheet, because if you've got 250,000 in income or 250,000 in profit and you don't have a balance sheet, you're going to get a fine and you're probably going to get an audit now. Balance sheets are big deals now, and it's one of the new enforcement areas that they're going to be documenting. And they just have to look at the return. And, oh, here's 250,000 plus, no balance sheet. Let's do an audit. Be preemptive in addressing prior year exposure. And I would go back to the last 3 years minimum and make sure that you don't have any ghost issues hanging out there that need to be looked at, because they will come up in an audit. Also, you have the new estate tax exemptions that are set to drop from the 13 to 7 million in 2026. There's another piece of legislation that's going to be doing something on this later in the year. So I'll have more to say about this estate issue when we get to, I think, the last number 5. The C Corps with the 21, obviously much more attractive than 39.7. Freezing the estate value using any one of these entities, especially a C Corp. When you do the estate freeze, what you're doing is you're locking in the estate value at a certain level preemptively and affirmatively by doing something like one of these entity structures, and you lock in future high exemptions or current high exemptions that you can use in the future. And there are some really cool advantages to being able to do that, especially using a C Corp. Also consider a C Corp for business holdings. In other words, a C Corp that holds the shares of all of your LLCs that own all of your ADUs and your rental properties and your cars and your trucks. Also look at gifting of appreciating assets now before the exemption sunsets. We might want to gift some of those and get through our gift exemption and avoid that tax trap. Document and pay officer salaries. Make sure you have a salary analysis. Make sure that it meets those 9 tests and action steps before the end of the year. Set a defensible salary using the industry benchmarks or software. There are several dozen IRS cases that talk about this and how they were arrived at. Formally document any salary justifications in the corporate minutes and with the report, and consider increasing the salaries in this year and next year, even though there might be future payroll tax hikes, because if you're not going to convert out of the S status, you're probably going to want to err on the side of a little bit more salary and not less. And then 6, leveraging the 179 for short life. This is stuff like ADU upgrades. This is a great opportunity to do some aggressive planning because you're going to be able to expense and get a higher limit where you just write off the whole amount. And if you're doing an improvement in building an ADU or a couple of ADUs or whatever, you could literally almost write the entire thing off in the first year if you structured this correctly. So you want to look at these things as opportunities for planning, and you probably want to consider at least doing a pro forma, because it's going to identify those areas that you might have some gaps where those are planning opportunities. And I'm going to tell you that these are big dollar savings, both now and in the years ahead. I would lock them in as many as I could, as soon as I could, because we're going to have a second round of this coming in the first part of next year with some of the reconciliation bills that are going to be coming. They're going to be adding some more meat to the bone in this legislation next year. Part of the effective planning techniques for personal are just very simple. You want to always make sure you have a 3-year baseline, a current year-to-date analysis, and transaction impact analysis, and forecast or mitigation of any 25 or 26 taxes. and make sure your 2026 pro forma at least is somewhat defined by October 1st. After October 1st, you're not going to be able to do much and pass the sniff test that it was not tax motivated. Business is pretty much the same thing, except I'm going to add reorganization plan analysis. That's something that I would suggest everybody with an S Corp at least consider looking at doing, and formal entity governance and plan documents that go with entity governance. If you're running a corporation, you actually have to follow the governance guidelines. It's now going to be part of the audit. Let's see. Oh, lastly, we run this think tank where we're talking about all this innovation, AI, robotics. Let me just give you something that's just kind of shocking. In less than 8 years, you're going to see robots deployed that can actually build a house where you won't need a human being. That's less than 8 years away right now. You're going to see things that are going to be shocking over the next 3 years, just data centers.
It's happening now out in Suffolk County. There's a company, it's the #1 company in the United States that are building 3D printed homes.
Yeah, these are different than 3D. These are stick-built homes with robots that actually use the hammering nail guns.
Oh, wow.
They're going to be able to build a house 40% cheaper.
Wow.
Right now, nationwide, we're building about 150,000 ADUs a year. By 2028, that number will go up to 600,000 a year.
Wow.
By 2030, California will have over 450,000 ADUs and doing about 200,000 of them a year. I'm telling you, the real estate industry is radically transforming. So what we do in this think tank is we talk about business and how innovation, robotics, and AI is going to affect business both now and in the years ahead. Because if you knew anything about AI, which I've been working with AI for 4 years now, if you knew how to do prompt commands, you would embrace AI because it would save you so much money and time. But if you don't know these things, you're not going to be able to be prepared. And the next generation is not going to have the basis for that. So part of this is an idea, sort of an idea mill of how we can bring these ideas to business and help other businesses adapt to these changes, many of which they're not even paying attention to know that these things are happening. And so you can send me an email. I'll give you some information. We do this on a Zoom about once a month. It's kind of fun and it's kind of cool, and some pretty good ideas come out of this a lot of the time that we can go back and share with people. And I think it's a lot of fun to be looking at this kind of stuff. Next, real quick on the list, you'll get an email, sign up to get on the list for an early release. Again, 6 to 8 weeks, we're going to have these ready. The published final version won't be until November 1st, right before Thanksgiving. But you'll get a copy early if you sign up, and it's 100% free. I want you to have it so that you can start getting ready to educate yourself on some of the things that you're probably going to need to look at that you probably haven't looked at for a while. And I would encourage you to look at these things because every one of them is an opportunity for you to significantly reduce your tax burden, both now and in the years ahead. So don't be afraid of that. Just embrace it and let's take a look at it and see where you're at. Also, inside of this, there's an editorial about the Trump doctrine. If you understood the doctrine that Trump is operating on, I think a lot of this would make a lot more sense. And the road to America greatness and what this tax legislation really means. Because it's more about 20 years from now than it is about now. And if you understood kind of why the policy changes happened the way that they did, these changes that we're seeing in the tax legislation are going to make a lot more sense. It's going to be 5 chapters of tax policies. It's going to have sections on the American taxpayer at large, American farmers, which are really going to be impacted, and investors. And then the agenda on the war on the American exceptionalism, and how through tax policy, these policies, how the Trump administration is fighting back through these policy enactments. I'm not taking a stand one way or the other. I'm just taking a position that this is the new law and there's more of this coming. And if you're not aware of it and don't know and understand how it works, you're not going to be able to take advantage of it and you're going to lose. You might lose a lot of money. If you want to sit down and have a cup of coffee and go over how this stuff might affect you, let me know and we'll sit down. We have our own Atlas AI system. It is powerful. It does a lot more than what a lot of people suspect that an AI could do. Everything that we do now is vetted through the process of these prompt commands so that we're looking at sort of a 3-dimensional dynamic modeling, and it gives us so much more capability and power to look at a financial position or a tax position and really come up with some really robust opportunities to help clients keep more of their money along with this legislation. Also, I would also encourage you that if you have the ability to be proactive in planning, be proactive in decisions, if you're making decisions to buy or dispose of assets, the longer the runway is and the timeline that you have before you have to do that, the better off you're going to be, because every time that you can add time to the planning cycle, it's going to save you a ton of money under these new laws. Don't miss the boat here. This is a really rare opportunity for you to really carve out some significant savings. Also, I would suggest that you look at sort of what your retirement structure looks like. We're going to cover some of that in the last session because that's all changing also. There were some announcements earlier, I think yesterday and today, about private equity firms being able to invest in 401ks. This private money, there's $7 trillion sitting on the sidelines right now. We just started the 20-year, year one is 2025, 20-year of the Great Wealth Transfer. The baby boomer generation, 79 million baby boomers, and trend generation that was enumerated in the book Upside, that 85 to 110 trillion dollars of wealth starts transferring this year. Billions of dollars every day is now transferring from that generation. And the impact that that's having is radically transforming the real estate industry. In less than 3 years, you'll be able to buy a piece of real estate and it will be on a digital coin, like a Bitcoin, and it will be on the blockchain. It's crazy what's happening. And if you don't know that these things are changing now, you're always going to be playing catch up. That's one of the reasons why we started this think tank, so we can start helping people get ahead of some of these changes that are coming. This wealth transfer is going to take 20 years for all this wealth to transfer. And nobody's paying attention to that. And it's changing the real estate industry. There's your link. We'll send it to you also in an email in case you didn't take a screenshot of it, so that you can click the link. Make sure you get on the list to reserve your copy of the free book. That way you don't have to pay for it. And with that, I want to thank you for your valuable time. Let me get to the last slide here and close this out, and I'll actually open up and take some questions if anybody's got any questions. All right, there we go. Let me see if we got any questions in the chat first. Can we get a copy of the PowerPoint? There will be in the back office. If you're not a member, join the membership because it's free for life. You join, it's free for life. You don't have to pay the annual subscription. And there will be an edited version tomorrow or the next day that's up there with all the other stuff that we keep a copy of, yes. Let me see the next one. Let's find the slides. Well, we can't provide the slides. It's just a recording of the presentation. Get on the list for the book. Yeah, so just hit that link and then we'll send it. Also, when you signed up, we got your email, so everybody's going to get an email. I've already got it queued up, ready to go out after we conclude tonight, and I'll send that out, and the link is in there, so just sign up and you'll get it right there. All right, that's all the questions that I see in the chat. Does anybody else have any other questions? Came in late, how can I get a copy? This recording will be in the back office, so if you're a member, you'll be able to log in and it will be there in the back office. If you're not a member, when you get the email this evening, just go to the website and join, because we're waiving the membership fee for life. You'll never have to pay for the member. I think it's $4.97 a year. You don't pay. The ebooks are free. The consults are free. The workshops are free. The webinars it's all free. Well, how do we make any money? Well, we hope when you do need to hire a professional to do something specific that you'll give us a shot to give you a proposal and we'll earn your business. Other than that, it's free. Take advantage of it and use it, because it's going to save you a boatload of money and probably a lot of time. All right. I don't see any other questions.
Hey, James.
Yeah, go ahead.
So the think tank, you said there'll be an email for that? I'm sorry if you said that.
Yeah, there'll be an email that'll go out tomorrow. I already got it ready to go, but I'll queue it up in the morning and send that out. And in the subject line, it'll just say think tank, and just give your name and your email or phone number and email contact. And then one of my team will get a hold of you in the next week and get you the information that you're going to need. And then we'll let you know when the next session is.
Perfect. Thank you.
Yeah, you bet.
Hi, James. It's Lee.
Hi, Lee.
Hi. I don't have any questions, but I just wanted to say that's a lot of useful information. I didn't understand absolutely everything, but I understood a lot of it. So thank you for all that. And also, I just wanted to let everyone know that I'm a client, and we have rentals and we have a business, and James and his team have absolutely saved us a ton of money over the last few years, a lot. And anyway, I guess since we're S Corp, I guess we're gonna have to consider re-electing to a C, right? Probably.
Yeah, actually, I've already started on several clients, including you, doing the preliminary analysis. And so, yes, that'll be on the agenda. We'll talk about, I know we have our real estate ADU webinar this Saturday, and then the Pathfinder also this Saturday. So probably early next week, I'll have Alan reach out and get you some information on that. The analysis doesn't take that long. We just want to run the numbers.
Yeah.
But I'm telling everybody, there's almost a 95% likelihood that if you have an S Corp, you're going to want to consider revoking the election by October 1st of this year for the next tax year, because the C Corp is going to be so much more favorable with what we can do in the other planning, and shifting some of those benefits under a C Corp is going to be a lot more, you're going to have a lot more bang for the buck, if you will.
Yeah. And so shifting to a C Corp, that's not going to mitigate any past liability. I mean, they're still going to be focused on people that had an S Corp.
Well, yeah, here's the thing about it won't affect prior years, but it will affect 2025, because everything that you and everybody else has done has been predicated without this tax enactment in place, number one. And number two, because of the retroactive nature of the legislation, it goes back and resets everything to January 20th forward. Well, what that means is that you probably have already significantly overpaid your taxes.
Okay. All right.
So it's going to be good news for almost everybody.
Okay. Awesome. Thank you, James.
Yeah, you bet. My pleasure, always. Oh, there's somebody put in the link in the thing there, the membership link. Thank you so much. I appreciate that. Well, this has been fun. It's been real. It's been real fun. Thank you very much, everybody. And we'll do this again next week. You'll get on the list and we'll keep you informed. Look for an email tonight and one tomorrow morning. And with that, if you got any questions, don't hesitate. Shoot me an email.